Hey, I'm Anne Cocquyt, and in this show we bring you the most inspiring stories from female entrepreneurs, investors, and innovators in our ecosystem, the Guild community.
Hello and welcome to the Guild Show this week with Denise Dunlap from Sage Growth Captial. Denise, I'm so excited to have you here to tell us about your company and your journey into investing and being a pioneer in the revenue-based financing world. So Denise, thank you so much for joining us here today.
Thank you for having me.
And, I want to jump right in and ask you, what was your journey like of becoming an investor in the revenue-based financing space? And maybe also tell our audience what exactly that is.
So I had a career in a variety of things prior to getting into angel investing. And I most recently had been the CEO of an IT services company, and we got that company sold. And at that point, I was looking for something to do, and I was invited to join my local angel group. And so I joined that group as an investor. It was all volunteer group, and we ended up starting a series of funds. And I ended up being the administrator of those funds, because that's what happens in volunteer groups, is whoever steps up to do the work ends up doing it, right? So I formed actually another company called Loon Creek Capital to provide the administrative services and carry the tribal knowledge of our local angel funds forward. And over time, I grew that company to provide services to angel investors all over the US. But part of what led me to Sage Growth Captial was I had served as that fund administrator. I also served some time working for Boise State University, running the business incubator. So of course I was working with entrepreneurs as well. And I started to see all of the challenges with our traditional equity model, not only of keeping investors engaged in writing checks over a long time period while they're waiting for their equity investments to mature, but I saw a lot of companies taking equity funding that they probably shouldn't have, or they weren't quite ready for it. It wasn't the right thing for them. And it forced them into some choices that they probably wouldn't have made otherwise if there had been other options available to them. So I started looking for some alternatives or augments or something, primarily from my fund administrator role, because I was worried about being able to start the next fund when my investors were all saying, hey, we're still waiting 20 years later, for our investments to mature. And so I became aware of revenue-based finance. There were a couple of pioneers in that space, and we're really leading the way in that. And I looked at it for a couple of years. And at that point, my partner, Molly Otter, moved to town, and she had some significant experience in revenue-based lending. And so she and I partnered up with my other partner, Kevin Learned, and the three of us formed Sage Growth Captial in 2019. And we just finished raising our second fund earlier this year. So you had asked me, what is revenue-based finance and why is it different? So what revenue-based finance is, it's a little bit like a loan and a little bit like an equity investment. And the way that it works is we invest in a company just like you would as an equity investor. We agree to put in, say, $100,000 into that company. The difference between equity and revenue-based finance is the company then agrees to pay us back on a regular basis out of the revenues of their company. So one of the things that's key to this is the company has to have cash flow, right? They've got to have revenues. They can't be post or pre-revenue company in order to qualify. So like a loan, that company pays us back on a monthly basis. And the way that the payments are structured is they are a percentage of that company's monthly sales. So when the sales are up, then the payments are up, and when the sales are down, the payments are down. So this is a nice sort of flexible mechanism for companies, especially if there's seasonality or we have crazy things that happen in the world like COVID that nobody saw coming. You're not stuck to that fixed payment like you would be with a bank loan. So the way that it's like an equity loan or an equity investment is we do expect equity-like returns. So with a bank loan, you've got a fixed interest rate of some percentage. With a revenue-based investment, the interest rate is not fixed. What is fixed is the multiple or the total return. So in an equity investment, your equity investors are going to expect 10 times their money back, 20 times their money back, as much as they can get, right? That return is not fixed. They expect to see that exponential return in exchange for taking on that early stage risk. A revenue-based investment, we do fix that return. Now we're looking to get 2 to 3 times back our money, but we also are not taking any ownership in your company. So that's a big thing, is when we get our money paid back, we go away, just like a loan. So I often get the question, okay, well, why would somebody take revenue-based financing versus a loan? Well, there's a couple of key points there. One, we don't require profitability. We do require cash flow, and we do require gross margins, but we don't require net profitability like a bank would. And two, we don't require personal guarantees or collateral like a bank would. So those are some of the benefits. I'll pause there and see if you have questions that you want to ask.
No, I love that, because you're right in that gap that exists in the market for entrepreneurs that are still high risk, but they have some cash flow. And then venture capital isn't quite right for them, like you mentioned, right? They're being pushed perhaps in some decisions or further on that are not quite the right decisions for the business. But then the bank loan might not be even a possibility for them, or they don't have the collateral, or don't want to put their house as a collateral on their SBA loan, right?
Mm-hmm.
And I've worked with entrepreneurs who have done that, and it's a decision that impacts the whole family, right? When
Yes.
actually this business should be separate from those personal finances, if you will, right? So I love the fact that you're right in that pocket, and I would love to hear from you, like, who are those entrepreneurs? I mean, there's the entrepreneurs that are like, yeah, we're going to be the unicorns and the decacorns, and here come venture capitalists and help us figure this out. We want to go fast, and we will burn a lot of money until we get to that point where we're reaching profitability. Then there's the businesses who are more service firms or e-commerce businesses. Maybe they do a clear co or some sort of a loan to get their inventory financed. But then who are the entrepreneurs typically that you see that are coming to you for that kind of a deal?
Yeah, so we are seeing a pretty big range of what companies find this kind of funding compelling. So there are certainly those that plan to be a unicorn or a decacorn or whatever it is, whatever the newest term is. They are certainly looking at that kind of funding. Not always, though. If they can get VC funding and all of that, they're probably not going to be looking at this kind of investment, because they're expecting to put every last dime back into growth, right? And we are seeing that companies that have taken venture or equity funding are looking at revenue-based finance, often as a bridge round. So where we're finding our funding fits in for those companies very well is, I've raised, maybe my Series C, my Series A, somewhere in there, and I need some additional growth capital, but I don't want to raise another equity round right now, or a convertible note that converts to equity, because A, I want to preserve my equity as long as I can, which all smart entrepreneurs should be thinking about. Or B, my early investors are like, I really don't want to write any more checks unless I have to. Or there's a variety of reasons why they might think about that, but those are usually the most common. So sometimes they don't necessarily want to go out and raise that round because they're not ready to discuss valuations, or they want to hit 1 or 2 more milestones before they discuss valuation, and they need that growth capital to kind of get to that next point. So that's really where we're seeing our funding fit for those companies that are going the equity path, is a bridge round, a growth round for a specific project. That makes a lot of sense to them. Most of the other companies that we're seeing that are looking at us don't want to go the equity route. They want to hang on to this company, and they don't want to be forced to sell it in order to pay their investors back at some point. They want to either hang on to that company and grow it and hand it off to their children, or they want to preserve the option to go the equity route maybe later. Maybe they haven't, they've got some revenues, but they haven't quite hit that market that they know is going to allow them to grow exponentially. And they don't want to be locked in to a specific path, because once you take that equity investment, you have to live up to the things that you've told your equity investors that you're going to do. And sometimes that doesn't mean pivoting 3 or 4 times, right? So that's one thing that our funding, we think is really a good fit, is it allows you to have more choices without locking yourself into a particular path. You can always take equity funding later, and most companies intend to, but we're seeing that they're looking at us as a way to sort of preserve those choices longer.
Yeah, and it's also a question of control, right? Where it's not just equity and giving up a piece of the cake, but it's also giving away control, because a lot of convertible notes or a lot of rounds or priced rounds come with a board seat that goes to the VC. And I think, like you say, at a certain stage, when you haven't really hit the next milestone, that may not make sense, right? And a lot of solo entrepreneurs also lose control very quickly in the equity rounds, right? Even at seed or Series A, you may already have lost majority in your company. And so I totally understand that. And that's why I also recommend this to founders to think about it, if that's an option, to preserve that equity and give up only 10% in the next round instead of 20%. And that's a huge difference, right? when you then have your $300 million exit at some point. Very cool. Amazing. So do you have any companies that have already paid back their initial loan from 2019?
Yeah. We actually had two companies, sort of a surprise to us and them, that they had change of control transactions. So, well, one of them was acquired, and it was not unexpected, but it was sort of a surprise. And that company, so what we expect when somebody has a change of control transaction, we have the option at that point to either convert to stock if we want to, which is not our goal. We prefer to get paid off or get paid back. And they told us, hey, the acquirer just wants to pay you off. Is that okay? And we said, sure. So for us, that's great, because again, the return is fixed. So they can pay us off anytime they want. And typically the terms of our loans are over about 5 years. So if we get paid back in 2 years versus 5 years, that's great for us, right? Because we end up having a much higher effective interest rate. The other company took some additional funding similar to ours, but a much larger chunk of money from a different group. And that group said, we want to pay these guys off and get rid of them. And so two of those companies paid us off within a year, which was great. We don't expect that to happen very often. Generally people, and we tell them it makes sense to stretch this out as long as you can, because then the effective interest rate to you is a lot less. Of course, and you have more opportunity to put that money to work without paying it back.
Right. So amazing. Those are great examples. And I'm sure your LPs are very happy about that as well.
Yes, they were very happy about that. They said, can we find more of those? We're like, well, we don't necessarily know that when we go in, right? So,
and it's interesting that you've been so involved in the angel community, and I think with the Angel Association of the US as well. Yep. And I remember when we talked, you said angels who are a little bit older, perhaps retired, they don't have that 10-year or 20-year horizon. Yeah. What a typical venture fund would look at, right? Like a typical venture fund is about 10-year horizon. For 3 years you invest, and then you have this exit window between 5 to 7 years, which also really pushes the companies into that path of like exit. Yep. And may not always be the best outcome for the company and the founders, right? Like what you said before, forced choices sometimes happen there. So if we switch over to the LP side, so the limited partners that invest in your fund to give their capital for you to deploy, what's their thought process? Like, how do they find you, and what do they like about this model other than the speed?
Yeah, so our fund is a little bit unique in the sense that we have raised it exclusively from existing angel investors. So we don't have any institutional investors involved with our funds. We did that because that was my background, right? So I know these angels all over the country, and part of the motivation for starting this fund was that I saw these angel groups all over the country dealing with some of the same challenges that my group here in Boise, Idaho was dealing with. Specifically, as you said, they don't have that time horizon to wait for those returns. They weren't seeing the kinds of unicorns and decacorns coming out of Boise, Idaho that maybe you see in Silicon Valley or Boston or wherever. And so those angel groups, the majority of the angel groups out there in the country have some similar issues that we did. And that was partly why we decided we wanted to partner with them, not only because it gave them another option to add to their portfolios, but because they were working with these companies all over the country in these, secondary and tertiary markets that didn't have access to something like this. And so we were really passionate about bringing something like this to these other markets where they still need those funds and they can't get them. But the angels that we work with, yes, they all were interested in how can I get returns back faster. So in our first fund, we collected from the companies monthly and distributed to the investors quarterly. And so in our second fund, we decided we're going to recycle those returns for the first 2 years, and then same cadence. We will then distribute to our investors quarterly after that. Well, it turns out that they love that. Investors love getting money back, as it turns out. And I've even had a couple of them tell me, you know what, you're funding my angel habit, because now I feel like I'm more confident I'm getting money back from you. I can write a few more checks, which that was sort of my hypothesis as a fund administrator. When I was thinking about this, I was like, I wonder if people are getting money back on a shorter basis, they will feel more comfortable making those other investments, because I felt like people were pulling back from writing those angel checks because they still had checks out there from 20 years ago that they're waiting for. So that's I think some of the thought processes of people investing in this. The investors got the concept right away. We had no problems raising either of our funds pretty quickly. What I also saw is people that I had known for years that had said, that angel investing thing that you do is crazy. I'll never do that. It's way too risky for me. They invested in my fund because they felt like this model of investing it was still risky, no doubt, but it's significantly de-risked to a large extent. And so they felt much more comfortable putting money into this fund. So that was also one of my working hypotheses, is that this would not only appeal to a wider range of companies, but it would appeal to a wider range of investors. And that has proven true in both cases. So pretty excited about that.
I'd love to learn from you what you think about the current downturn. You just raised your fund this year, maybe already in the downturn, I don't know, but you probably also see a lot more entrepreneurs come to you who have a harder time raising A right now. We see some of these trickle down effects from the later stage pullback in terms of funding now also affecting A rounds and seed rounds, even though they're still pretty much at the same valuations as last year. But we know that these trends typically pull through about 12 months later, right?
Yep.
So what do you think about this downturn, and where do you see it go, and how do you prepare for that?
Sure. Well, the positive of any downturn is that it has the effect of reducing some of the froth, right? We've seen valuations getting crazy, which is great for entrepreneurs, sort of, until something like this happens, right? But it's definitely, we're going to see that, as you said, maybe not right now, but soon. I mean, everything I've read and seen is that people are pulling back, in venture capital firms and angel investors, equity investors are all sort of holding back. And that's a direct reflection of what's going on in the stock market too, right? So I think that will continue. What I'm not sure about, and some people say, that this is going to go on for years. Others say it's going to be a quick turnaround. I don't know. I do think that companies are going to need to be prepared to ride it out. And, the same advice that you've probably heard from other people, focus on your cash flow, because that will kill you faster than anything else, right? Focus on your profitability. That's not something that unicorns and decacorns are ever told to do. And now all of a sudden they're being forced to look at that. I do think that we're going to see a shaking out of some of these companies that just won't survive that because they don't have that cash flow. Companies that have cash flow are going to be way further ahead because they can survive on that if they have to. So I don't know if you want me to comment on that necessarily or my own perspective, but we expect to see more companies coming to us for this kind of funding because they won't be able to get it elsewhere. And it's not just the equity investors and venture capital firms that are tightening up, the banks are tightening up too. We all see all the interest rates rising, and they now are encouraging us all to put money into our savings accounts. Well, but you can't get a loan very easily. I'm seeing really interesting things like banks putting holds on checks longer than they used to. So everybody's becoming much more cash conscious and conserving that cash wherever they can. So frankly, this is a great time for somebody like me in our fund. We have money to invest in companies that have cash flow. That's what we're looking for. Obviously, we will be looking at their ability to survive in this environment and how they have been stewards of their cash in the past, and what are their plans for getting through this. Or, obviously some companies thrive in these kinds of environments. Those are great too. And we have the money to invest in those as well. So, we'll be smart about it. We'll look at growth plans and survival plans as well. But I do expect, and we have already started to see more of a deal flow with stronger companies coming to us, I think, because they're looking at that and going, okay, we need to plan ahead, and we're probably not going to raise that equity round this year. So let's go out and get some funds, to hold against, uncertainty. And so, that's a great thing. From our fund and our perspective, it is a really good opportunity.
Yeah, and at the Guild, we also have our 8-week self-paced Guild Academy program now that really helps first-time entrepreneurs take the first steps to launch their business. And at the end of that program, people have a pitch deck that they can take and go out with. But it's not just to get investment, it's also to basically take the steps to build your business and hopefully reach profitability. And we have a financial planning template that tells you at which point you can expect to hit break even. And then you can use a pitch deck as well to go out and find a co-founder, advisors, or talk to potential sales partners or clients, right?
Yep.
So that's what we do in the Guild Academy. And we very much also focus on the businesses that just want to build a great business, get the first clients, have traction, and then decide, is it now time to put more cash into the business to fuel that growth? Is it now time to take on a loan, a bank loan? Is this the right business for a grant, perhaps? Or should we go and do revenue-based financing or go on the venture capital path? And so we help the entrepreneurs in that program decipher all that and try to understand, okay, here is what we are going to do. And we're confident in that choice as well, I think, because a lot of people don't know, right? And then
I think that what you're doing is great, because I do think that entrepreneurs rarely hear a range of options, right? I think that they hear over and over, and they see in the news, you've got to go raise equity, you've got to go raise equity. Well, they don't always know what that means and what that's committing them to. And often they're into it before they realize, and at that point it's too late. And that's unfortunate. I mean, that was one of the things, I mentioned that I've worked with entrepreneurs and I saw that happening, and I felt like I was the lone voice in the wilderness saying, hey, wait a minute, focus on profitability, focus on this and that. And that gives you choices that you won't have if you're taking somebody else's money. So you need to be aware of what the various options will do, and be informed, make a choice.
Well, and that's what we're all about, right? Like inform you, give you the knowledge to make great decisions and to grow your businesses. Now, Denise, how can we help you with Sage Growth Capital or you personally?
Yeah. I think that the best thing you can do is just help us spread the word. Revenue-based finance is still fairly new concept to a lot of companies, and they don't really know what it means or whether it's right for them. And I would just encourage you to continue spreading the word about, make an informed choice, develop a capital strategy. It's no different than having a marketing plan or a staffing plan. You need to have a capital plan as well, and think about how that will work. And if we're of interest to you, certainly reach out to us. We do have information on our website about our ideal candidate and the qualifications that we're looking for. We're a small team. We love working with companies. We're excited to see this asset class grow. And I'm always willing to talk about it. So if anybody wants to hear about revenue-based finance, I'm happy to do speaking engagements and talk about that too. So that's probably the best thing you can do for me, is just help spread the word.
Amazing. Thank you, Denise. We'll spread the word, and we'll thank Nancy, who initially introduced us. So thanks so much for coming on the show, Denise.
Yep, you're welcome. Super fun.
If you're inspired, then subscribe to our channels on YouTube, on our social media channels at Get Gilded, and also on our platform, letsgild.com. You can also sign up to our newsletter to get news about the latest and greatest in inspiring stories from female founders, entrepreneurs, investors, and innovators in the Guild. I'll see you next time.